Hey everyone, we're back and we have Danilo Terra from Pillar Capital. Thanks for joining me, bud.
Oh, my pleasure. Thanks for having me.
So, I promised myself last time I wouldn't say so often. It's kind of my
That's good.
kind of my
Comfort words.
Yeah. We brought you here to talk about alternative finance, and so why don't you do that for us and maybe explain where Pillar fits into that?
Yeah, sure. Well, the world of alternative finance, and it's a big world, and it encompasses a lot of different things. Always, at Pillar, we believe that companies should have options for liquidity, for capital that goes beyond the banks. And it's not just when the banks say no, because we work very well with banks in certain situations where bridge finance or short term, sometimes that intermediary. It's just we believe that companies should have the option for capital, for growth, for restructuring, and lots of different things. Alternative finance kind of fits into that world. It allows them to grow without just that same standard bank financing. I always say financing for companies like one of those toddler puzzles with the big pieces. You're going to get some here, you're going to get some here, and a little equity here, and that alternative financing. Sometimes there are those other big pieces of the puzzle that fit together quite nice. A lot of times it's not just one option; it's those pieces that fit together. So I think that's the world of alternative finance. Those pieces that kind of complete an entire financial picture for a company.
Mm-hmm. And where does Pillar fit into that?
Right, so Pillar fits in on. We do deals from about $100,000 to $10 million. We're an asset-based lender, so we finance based on equipment or property and land. Marketable, tangible assets is what we refinance. We refinance. It's a bridge loan, so generally 12 months and under. Although you can renew for us longer, generally with that short-term access to capital for a variety of situations.
Yeah, the term ABL gets thrown around in different ways, right? Because a lot of people will know ABL as more of a working capital product, right? Where everybody's familiar with a borrowing base, right? And a lot of mid-market businesses are going to have call it an ABL light borrowing base, but a true ABL revolver, it's much more intensive, right? It's AR, it's inventory, but it's audited, it's appraised. The lenders are walking through, like it's an onerous facility. So we're not talking about that. We're talking about a term loan product, right?
That's right. It's a term loan product. There are situations we go interest only on that, but it's a term loan product. It's not a lease. We do finance equipment, but it's a term loan product. Exactly.
Why don't we talk a bit more about commonly financed assets specific to Pillar?
Yeah. Okay. So, we always say our world is a simple world. And what do we like to finance? Now, we can get creative. It's a small group. It's about 7 of us across the country, industry agnostic. So we don't focus in on any one industry. So because of that, you're seeing lots of different kinds of assets. So on the equipment side, it's stuff that I always say that you can see in the Ritchie Brothers auctions. So, stuff with the tires and engines, that yellow iron, the trucks, the trailers, the energy service equipment. But it's also manufacturing equipment. It's, we've done some deals out east in the fishery industry. So it really is all encompassing on that, but it's generally tangible equipment that can be remarketed, that has another use, that isn't subject to quick obsolescence. So some of the technology isn't something we play around with, or the cannabis space, which had such the equipment changed so quickly, so fast. And then on the land side, it's generally marketable property, houses, owner-occupied buildings, or commercial buildings. So that kind of sheds some light on the type of assets we do. We're getting in some reserve-based lending in a small way. And then the nature of our business is we can be flexible. So we always love to hear the story, and we try and find a way.
For those that maybe don't know, reserve-based lending, like you're referring to like upstream production?
That's right. Yeah, some production. So we're starting that. There's a gap for capital in that, so we're kind of exploring some of that, and we do have somebody on the team with some expertise on that. So
yeah, I would think a lot of people in Calgary. Well, there would be a lot of people in Calgary that would be very aware of the gap in capital for upstream production, because I remember being at the bank, and so we never financed them. It all went to the corporate bank.
Right.
In part because they had engineers that knew how to read a reserve report. I don't know how to read a reserve report. Typically, it had to be over 10,000 barrels a day, or BOE a day, and it had to be a really established, well-known management team, which meant they were pretty much financing everything they wanted to finance. And every now and again, you'd have something come through the retail bank that said, oh, hey, we got this land, and maybe 1,000, 2,000 barrels a day. There was a time when, ATB kind of filled that void.
Mm-hmm.
And my perception, I've never worked at the ATB, you have, my perception is that changed like several years ago. And there was just we didn't know where to send that stuff.
Yeah, that's, it's a volatile market, just like the commodity. I think we're in a good run right now. But it's a very small part of what we do, but we're definitely looking at it. So, which is interesting.
If you think about all the stuff that you guys see, and you see a ton of different stuff, are there common assets that you're presented with that you can't finance? You talked about cannabis, but anything else?
Yeah, some of that technology assets, those computers, those real equipment that would be subject to high obsolescence, that maybe don't have identifiers on them or serialization on the properties that are really remote areas which don't have a lot of activity for sales, and that really hard to kind of quantify even on a value or appraisal basis. So I would say those are always difficult. So
I think about like small town Saskatchewan. There are a bunch of rural territories that might have, let's say, less than 1,000 people. And you can get an appraisal, right? You'll get an appraisal, and an appraisal might say $1 million, but the challenge for some of those properties, and you can tell me if you disagree, but like the challenge for some of those properties is the only lender that might be open to them might be the local credit union. And if you piss off that local credit union, you might not have another financing source. And that appraisal, like despite the appraisal saying you might have $1 million property, it's trapped capital.
It is. It's worth what somebody might want to pay for it. And we always say, what could it sell for within 90 days? And I mean, it's the collateral is one piece of the picture for us. We're also looking, at management. We're looking at our exit. We're a bridge financer. So what is the exit? Possibly they're selling it, or there's an acquisition going on, or there's a bank on the sideline. Sometimes we have banks just say, Pillar, do you mind financing this for a couple months while we get our ducks in a row and get this funded and through due diligence and legal? So different situations, but yeah, it is unique what we see in the alternative finance world. It's interesting every day, isn't it?
So in terms of being, I said so again, I can't help it. In terms of being a bridge lender and wanting a path to takeout, you don't need committed financing. You don't need committed takeout financing in place. You just need a story, yes?
That's right. Yeah. We're looking for that. We're looking for something that makes sense. We've heard it all, right? So, if they're working with somebody like you, we have that confidence that they're going to have that support, through that transaction, and for the exit. A lot of, we hear sometimes we just need those year ends done. Okay, but we know it takes 98 days to get those year ends, so you actually need a year end and those 3 months. Oh, and then the bank's going to take a month. So we really hone that in, but we have to be realistic on those exits, and that's fine. So,
coming from the bank, just going back to talking about appraisals, especially on real estate, and some banks might differ, I guess, but there was a real focus on income approach.
Right.
And my sense is that you guys might not rely on income approach quite as much as you might rely on comps.
That's correct. Yeah. We are focused on comps, but we read that whole appraisal, and we do respect that and those other mechanisms. We feel that, one translates into the other. We do rely on comps, and we want to see that active secondary market, to really justify the value of that property.
So that's important to think about when either a borrower or even a lender are reading the appraisal rate, because there are instances where the comps, one, it could be an active listing, or two, it could be from 2-3 years ago, or it could be from an adjacent community. I mean, the devil's really in the details with some of those comparables. Eh?
Yeah, absolutely. Google Maps is your friend, and industry is our friend. We really check. We rely on our industry partners and our friends to really confirm things. We kick tires. It's something I was taught in equipment finance since the beginning, is really get out there and see what you're financing, feel it, and it can really make a difference, to the positive. So that's important. We don't have financial covenants in our loans, right? So because of that, we are focused on the asset, and you'll see us take the time on that, even though we can quickly turn around some transactions.
I think that's one thing that really gets understated or underappreciated. I mean, even in commercial, where there's so many different terms and conditions to consider on a loan, like, everybody still gets pretty razor focused on pricing, right?
Right.
But to your point, like, few or no covenants, like, there's a ton of underappreciated value in that, particularly if we're talking about transitional periods for a business, because you don't want defaults.
Right.
And that gives you the time to turn around the business or whatever you're trying to do. I mean, if you're with Pillar, I mean, I guess you could get approached just because tight timing, right? A bank can't necessarily accommodate really tight closes, but in a lot of cases, it's a business where the business is changing a lot,
right?
Either up or down or whatever the situation is. Having no covenants, that's not something you can get from a traditional bank.
Yeah, you're bang on. Those interim situations are so important, and things can change so much, and yet you could breach on one of your monthly reportings until the transaction is completed, until it's restructured the way you want, until certain assets are sold as part of it. When you're buying a new fleet or something, a lot of good growth, great companies just need that quick access. We always say we're cheaper than equity, and we're that short-term, option. So you can pay us out penalties free after 3 months. So we always say an open facility after 3 months, and gives you that flexibility really to move that transaction along as required. Yeah.
Yeah. No, totally. Did you have examples of where Pillar makes a lot of sense? I mean, we talked about assets that make a lot of sense, but did you have any recent situations that are kind of worth pointing out for people?
Yeah, it's pretty interesting right now, because I always say it's a COVID hangover. We're coming out of a unique, unprecedented time where banks did step up to the plate, and kudos to them for support. Now we're coming through a period, I believe, of change where they're trying to get back to normalcy, but you're still focused on a rearview mirror financial adjudication system. So you're looking at 2 years that maybe weren't the best. So if you apply those metrics, green light, you're applying back to normal, but the last 2 years haven't been strong, you're going to have some challenges. So are we seeing some bank exits? Yeah. So demarketing by the banks? Yeah. Are those, would you call them distressed? No, I think some companies have great runway and some great work lined up. So they're caught in that interim time where maybe it's time to switch. Maybe it's time to kind of relook at that financial situation with professionals and tighten up certain ways. So we're seeing those. We're seeing, I think there's going to be opportunities out there for companies to acquire. Succession's huge. People have gone through that COVID scenario, managed through it, have now postured for growth, doing well. they're thinking about that exit, that baby boomer generation. And that's going to take liquidity and creativity. So we're seeing scenarios there. Over the fall, we saw a lot of land and a lot of on the and buildings, like real estate assets for finance. Now we're seeing a lot of equipment deals. So it is changing. That's what keeps it. That's what I love is the different conversations, the different kinds of assets. I'm learning every day. It's awesome. So we're seeing lots of different things.
Have you noticed, I've seen a couple of posts about year-over-year loan loss provisions for some of these banks.
Mm-hmm.
They're 5-6 times year-over-year. What do you guys think about that when you're kind of trying to plan your capacity for the next little while? Because I would assume that might be good for you guys.
It's definitely that time of change, and where the banks are really analyzing their portfolio, where Canada is in general, Austria is in general. Where are we in terms of health and stability in the markets? That inflation, how's that impacting everybody? So interesting. So there is focus on that. I think there is a renewed, that brand reputation of possibly moving some companies out. We've seen some companies get free passes through COVID that maybe, the banks should have demarketed or exited earlier prior to that. And we're seeing, now they haven't been able to restructure, improve. So, I joined in Pillar in September, and I think there's a reason for that. We're expecting some busy times, and we're here to assist and help. So
there was a lot of liquidity out there that I guess afforded traditional lenders the ability to be patient, right?
That's right.
It definitely feels like there might have been, call it shadow management going on, where you might have businesses that were struggling a little bit, but you keep them in the mid-market branches and just keep an eye on them, whereas maybe now they're not messing around with that. Like, they're just moving them to special loans a little more proactively than they otherwise might. And maybe that's the only reason that you're seeing more loan losses, loan loss provisions. But even in the last, I think, 3 weeks, I've seen at least 2 special loans situations. One probably felt a little premature, but I mean, there's something in the market for sure.
Yeah, the winds of change are here. I'm I have a lot of conversations every day, and similar to that, we're seeing brokers and financial professionals getting more calls, having those conversations. We're seeing special loan groups and restructuring groups get larger in size, if that's not a testament. A few more smiles on the faces in the insolvency community, which seems bad, but that is a whole industry, right? And the economy does ebb and flow, and we're also seeing some really good and strong things, and some companies doing very well. So it's interesting.
I think people probably don't know all that much about the special loans groups, in part because if you're a bank, you don't want to really over promote that part of the business, but for by and large, like most banks, like there's a retention strategy involved. Like you're incentivized on your scorecard based on how many deals you're able to retain and return to the branch. Like they're not breaking people's knees in a lot of cases. Like they want to help these businesses through difficult times. They move them there because they have fewer account loadings, and they're able to give them the TLC required. They have the expertise as well for these difficult situations. The mid-market branches, they have new business objectives, and they just can't afford to get bogged down. So
you're bang on. Yeah, it's a lot. They have the ability to be way more flexible with the client, and grant that those special provisions. It truly can be a good place for a company to restructure and move out of. I truly believe that. But information is key. If your reporting is not up to date, or it's not speedy, and and there's mistakes in it, that's not going to help at all. They have little patience for that. So really get your reporting up to snuff on that. Communication is key. with those.
Pick up the damn phone.
Yeah, you really got to communicate with your special accounts person, but they can definitely help and transition back. And there's times that maybe the relationship is soured with that financial institution, time to move on. And that's where, yourself comes in to kind of find that new home, right? Package it accordingly. So lots of different options there.
Yeah, it is hard. Those lenders, sometimes they can't unknow what they know.
Right.
So sometimes there's no way to kind of come back from the relationship. But I mean, I think the first time you get transferred to special loans, hopefully it only ever happens once to you, but it's a pretty alarming concept. And I think there's a tendency to, you'll protect information. You'll conceal information from the lender, and they don't have a lot of patience for that. Like you have to over communicate, and if you over communicate, I mean, it still might be uncomfortable, but like you'll get the patience and the cooperation that I think you really are probably shooting for, right?
That's right, and I mean, and your advisors are so key in that, to help you through that so that you can manage your business. It's definitely a unique situation to be in. But you talk to some old successful entrepreneurs, and they'll tell you how many times they've been in that kind of penalty box or special credit restructuring, and it's part of the foundation and DNA of their business coming back from that and the learnings, right? So yeah, it's definitely part of a life cycle sometimes, right? So.
Any other financing market observations you have more recently? I mean, there's just so much change. Like, to your point, think about all the macro things that adjudicators in business have to think about. I mean, it's almost too much. Like, don't read the news. Yeah,
definitely. Those rates are having an impact. Everyone thinks that they're going to have an immediate impact on the economy. No, it's when things come up for renewal. So, we're seeing some companies, we knew it was coming, but we didn't really pay attention, and we thought we'd sold it by then and that, or when we're on a floating rate mortgage, and wow, we didn't realize it was that much, or the construction supply chain, we didn't realize it's going to take an extra year to build that, and we weren't accounting on it. We're seeing some different things out there. Definitely. I mean, our own vehicles. I'm an equipment guy. Those trucks, those pickup trucks, when dealerships are buying them for more than you paid for them, I mean, that's a little kind of offset that shouldn't be happening. So do we expect prices on equipment to adjust? I think so. Maybe properties as well. So that's why we can never go at 100% loan to value on your appraised value of your truck or your land. We're expecting some adjustments to come. I think it's natural to see in this environment. So
yeah. I talked to somebody who had a $9 million mortgage, and it was floating, and you don't see that a lot, but I thought that was such a silly idea, to be honest with you. And the only reason I say that, I mean, to each their own, right? Like, it's one thing to do it with your primary mortgage. If your primary mortgage is hopefully not a huge number, or even in a residential investment mortgage, but like for a business mortgage, I mean, you have so many risks in your business already. You think about customer concentration and getting paid by the customers and labor, and it seemed short-sighted to be floating on a mortgage like that, only because, like, manage the risks you can manage.
Yeah.
Whether it's fixed or whether you do a BA swap or whatever. I know you risk losing some money on the hedge, but you're not trying to make money on the rate. You're trying to establish certainty.
That's right. Oh, it's so key. But I mean, our DNA is banking. Both of us. So we're a little conservative on that end. But I saw it in the equipment world when I was with ATB, and others. Why would you want to? Sometimes I always said, why would you want to float? Your equipment financing. You're preparing quotes. On clarity is a good thing, and to have those equipment financing numbers so fixed through a term is a really good thing. So I think people have got caught, but other times in other markets they win on those. So you never know, right?
It only takes once for them to convince themselves that they're a genius.
You never know.
How about you yourself? I mean, tell us about your background and expertise. I mean, from what I know about you, I mean, you're a pretty experienced banker and a bit of an equipment guy, if you will.
Yeah, I love the equipment financing world, and my roots are commercial banking. So 2001, I joined HSBC on their energy service team, and then quickly moved to the equipment finance group there, and kind of was schooled under an equipment lease guru. So I still have some of his calculations on track leases and all that. And his name was Jerry Larkey. He's since retired, and so I did 11 years at HSBC. Then I became a broker, equipment finance broker of the LeaseX, and also dabbled in the alternative financing world. So I had Danilo Terra Capital Strategies, and doing some bank exits there and that sort of thing. That's kind of the roots of Pillar. We're about 10 years ago there, and so I was brokering deals to them. So I knew them for quite a while. Then the past 5 years with the ATB's equipment finance group, helping them grow in Southern Alberta. That was fun, and a great team there. So hugs and handshakes when I left there, but felt the opportunity with Pillar, and the winds of change were such that it was a good time to kind of move over to an asset-based lender.
I think about my own career path. Like, I was with one bank the whole time.
Wow, that's awesome.
Pros and cons, right?
Yeah.
But you have this unique experience of seeing how different banks do things, right? They're not all internally, right? They're not all the same. Their offering isn't all the same. When you first went to a different bank, were you surprised at how different the offerings were?
Yeah, it's been amazing. Now, only 2 banks, right? So I definitely
2 times more than me.
Yeah, that's right, I guess. But I think you're younger than me. So
I don't look it.
And but where I really saw the difference was brokering to different financial institutions. You really see a different mandate, different risk appetite, and that pendulum swings, and that organization can some sway and change. There are differences. I think they all kind of have to report into OSFI the same way. OSFI is the Office of the Superintendent of Financial Institutions, kind of a government run that looks after all our banks. So I think the capital adequacy and all those buzzwords that banks use, they all have the same mandate. It's the buckets they choose to be aggressive in or not, and how they play around with their portfolio mix that kind of drives where they want sales and where they're pricing things. So it's interesting. But yeah, they're different companies, just like every company is a little bit different than a competitor. Lately, I don't know if you've seen this, and after COVID, there's been a lot of bankers kind of shift around, right? And so it's interesting. I asked a similar question: hey, what are the differences? Do you like it better? It's another big bank. Is it? And it's interesting to hear those answers. So
I thought there was one way to do things until I came into this broker role, and I've been really enlightened by how different the offerings can be, and that's part of the challenge with the commercial market. Like, you think about the residential market, right? Like, where really only rate matters for most people. There are like websites you can go to see what each bank is offering for a posted rate, like Rate Hub or something like that. There's no website like that for commercial, right? You have to go and get term sheets,
right?
It's just, so it's opaque for the customer, but it's kind of opaque for the lenders too, right? Like, if you're in a competitive situation, I don't necessarily know what the other bank is going to do, so it's difficult. Like, if I am a banker, like, it's not easy for me to necessarily provide the best deal possible if I don't know what the competition can do, right?
Yeah, no, it's definitely unique. I mean, they use the term relationship manager. I think commercial banking still has a lot to do with relationships and understanding that business. And customer can do certain things, like establish that relationship, and acknowledging that there are going to be a lot of switches of relationship managers through the day. I think we all have to just understand that. A lot of clients get, I have another account manager. That's the nature of the business. So get to know them, and it's going to happen anywhere. And tighten up your package. It's amazing how many times we get calls and I'm still not clear on the ask. It's so we always, like that Dragon's Den, they always focus in. So how much you need and that sort of thing. And that's why capital advisors such as yourself and that really kind of package that so well. And you've had to have the ability to establish those relationships for the customers, right? So
yeah, it's not that a customer can't do what we do.
Right.
We can just do it faster and more efficiently, right? Like I can call 4 bankers today. Like we just know who to call. Like you don't have to go through the retail branches and try to figure out who the account managers are. And God forbid you get an account manager that you don't like dealing with. But
and you have that rapport so you can speak openly. And you highlight the risks, but you highlight the mitigating factors that you know about because you know the company, right? Yeah. Totally. So it's definitely good. Yeah.
So we're at 32 minutes.
That went quick.
How about final advice for the audience?
Final advice.
And we're assuming the audience is more than just my family members right now.
I think it's utilize the experts in the field. So if it's an accountant, really, that's great value. Make sure you're meeting with them regularly. I think you need to know where you've been to know where you're going. Financials, forecasts. You'd be surprised how many heavy equipment customers don't even have a proper equipment list that they can provide me with year, make, model, and how many hours and kilometers. Just having that information is key, and utilizing your network, be it your broker, and that. So I think focus on your business and really utilize, be it legal and lawyers, utilize the professionals to do what they're good at, and don't be afraid to ask questions. I know when we love having those conversations, and we always try and put the client in a better place. So if we have to say no, well, have you considered this or these advisors and that? So it's important to just have those conversations, be honest, and it's going to be a different year, and I think it's going to be a good year. I think there's going to be a lot of opportunities. So all the best to everybody out there. Thanks for have fun.
Yeah, I think about the smaller the business, maybe the bigger an issue this tends to be, but there's just an inability or an unwillingness to recognize when you need to ask for help.
Right.
And it goes beyond, it just applies to all sorts of situations. I mean, it could be consulting, it could be advisory related, whatever, but
right. Yeah.
I think it's probably a money thing.
Yeah.
But you got to recognize that you only got 24 hours in the day, right?
Right. Well, I was, if somebody's doing your bookkeeping or sourcing financing for you or talking to the bank, and you're paying them, and you're unhappy that you have to incur that expense. Well, how about you cold call and focus on your marketing during that time and grow that business, right? And do what you're really good at. So, it's I think I see the value of the clients that really embrace the professionals around them.
Yeah, no, it makes sense, man.
Yeah.
So where can people find you online?
Well, our website on pillarcapital.com and or on LinkedIn. Everyone sees me out and about. I love that. So I love getting out there in the industry and at the banking functions and industry functions. I know we're attending one later today with the Premier. And I'm out and about. I'm easy to find. I'm walking down downtown and Calgary, but we're traveling a lot over Western Canada. So feel free to connect on LinkedIn or through yourself, and happy to chat and have those conversations. So that's all where it starts.
Sweet. Thanks, fella. I appreciate it.
Thanks a lot. Appreciate being here.
All right on. Well, we'll talk soon.
Sounds great.
Cool.
Take care.